Hey and welcome back to a new video here on the Tradeciety daily video series. So the last time we talked about the reward to risk ratio and how to measure it and what it can be used for. And today we want to introduce a new feature which can be combined with the reward to risk ratio to overcome some of the problems and weaknesses of that ratio. So as we said on the last video, the reward ratio measures the potential reward and the potential risk, and then builds the ratio to provide information about expectancy and whether or not the trade should be taken or not, depending on if you have a good and large enough outcome on that trade. However, the keyword here and the problem is the word potential, because often traders are very optimistic when they enter the trade. They might use small stop loss orders to generate a large reward to risk ratio, or they're too optimistic on the take profit part of their trade, and then price can reach the take profit order, and the finalized trade then differs very much from what they planned out. So the reward to risk ratio often misses what happens during the trade and does not take into account problems traders have with trade management, letting profits run, or closing unprofitable trades. For that, in trading we use the concept of RMultiple, where R stands for risk, so this is the risk multiple, and it's a performance metrics, and with the RMultiple we measure the outcome of the trade in terms of risk. So let's look at an example to see what this actually means. Here we have a potential trade. The entry is at 100. Your stop loss is at 90, which means you could lose 10 on the trade. The take profit is set at 120, and you could make 20 on that trade. So this would result in a reward to risk ratio of 2:1 when you divide 20 by 10. This we covered during the last video. Let's explore what happens to the reward to risk ratio and the RMultiple during our trade, depending on the outcome. So first, let's say we close the trade at 110, which is ahead of our initial take profit. Instead of making 20, we only make $10, and you can see it's the same as we have risk on the trade here on the stop loss distance. So in terms of R and risk multiple, we only made 1 because it's the same as our stop loss and potential risk. On the second outcome, we closed our trade for a loss, exactly where our stop loss was. We lost 10, and this is the outcome of -1, because in terms of risk multiple, we lost exactly our initial risk. And the third outcome is we let our trade run beyond our initial stop loss. Maybe we have widened it or taken it off because we thought price may turn around, and we realized the outcome of -20 instead of 10, which is double the initial risk. So in terms of our multiple, we lost -2. And now you can see already that we can use the RMultiple very nicely to measure the finalized and real outcome of our trades. And it's a very popular measurement in performance analysis of trading because it already combines a risk component instead of just looking at the outcome. Like so many traders just look at pips or points or US dollars or whatever and then judge their trading based on that. But this does not tell the whole story, and adding a risk component like with the RMultiple can help you a lot more understand your trading performance. And here are some more tips around using the RRR and the risk multiple together. So first, you should always compare your initial risk reward ratio to the final RMultiple. So if you see that the initial risk reward ratio is always much larger than the finalized risk multiple, then it might highlight a problem with your exit taking or with your take profit. Maybe you always set your take profits too far and too optimistic, or you manually close your trades ahead of your take profit and so reduce the RMultiple. And also what is very important, especially for new and inexperienced traders, is to be aware of RMultiples that are smaller than -1. So as we saw in our previous example, if you see that your risk multiple is something like -2, -3, or anything smaller than -1, then this means that you let price run beyond your initial stop loss order, and this can always highlight emotional problems and trading based on hope and not adhering to your trading rules and principles. And that's how I would use the reward to risk ratio and the RMultiple and combine them together to get a much better picture of your overall trading and your performance. I also post the link in the description below to a more detailed step-by-step article around this concept as well if you want to explore it further. Happy trading, and don't forget to subscribe to my YouTube channel for more updates daily.